and welcome to the Business English Podcast. I'm Jer from Learning English Pro, a CELTA qualified business English teacher. In today's episode, we're diving deep into the world of banking jargon. We'll cover 10 advanced terms you're likely to hear in corporate banking and finance, from loans and liquidity to capital buffers and hedging. If you've been following along, you might remember in episode 7 we talked about international trade. Today we'll build on that by exploring the banking side of corporate finance. By the end of this episode, you'll feel confident using terms like syndicated loan, liquidity reserve, non-performing loan, and more in real business conversations. Before we start, a quick note: if you find this episode useful, please subscribe and hit the like button. Leave a comment with any banking terms you'd like me to cover in future, and remember to check out my Business English playlist for more lessons like this. If you want extra practice, consider joining my student membership for $4.99 a month. For this episode, you'll get a PDF worksheet complete with a glossary, definitions, and example sentences, and even 2 comprehension exercises. It's a great way to lock in what you learned today. Alright, let's start with term number 1, syndicated loan and revolving credit facilities. Imagine you work in a mid-sized company and the CFO calls you. We just signed a syndicated loan of $100 million with a group of banks. What does that mean? A syndicated loan is a big corporate loan provided by multiple banks working together as a consortium. Instead of one bank lending the whole amount, several banks share the risk and each provides part of the funding. Syndication is common for large deals because no single bank wants to take on too much risk. In May 2025, the Lenzing Group, a major European fibre manufacturer, agreed a syndicated loan of $545 million with a consortium including Commerzbank, BNP Paribas, and others. That loan had 2 parts: a 3-year term loan of $355 million and a $190 million revolving credit facility. A revolving credit facility, or line of credit, works like a corporate credit card. The company can draw down funds up to a limit, repay it, and borrow again as needed. It's very flexible for day-to-day cash needs. In contrast, the term loan portion is a fixed amount that's paid back over its term. By joining a syndicate of banks, companies can shore up their financing. For example, Lenzing's CFO said this deal strengthens their liquidity reserves for future needs. Here we see 2 more useful terms. Liquidity reserves are cash or credit lines that a company keeps for emergencies or upcoming payments. And shore up, a phrasal verb, means to strengthen or support something. The banks themselves also have roles in the syndicate. 1 or 2 act as lead arrangers or book runners, structuring the deal and then distributing the loan parts to other lenders. You might hear phrases like lead arranger or book runner in the news about big loans. Another concept related to loans is collateral. If your company borrows money, the bank may require collateral, an asset pledged to secure the loan. For instance, a company might offer real estate, equipment, or even inventory as collateral. If the borrower defaults, the bank has the right to seize that asset. Collateral makes a loan secured debt. In our Lenzing example, the term loan might be secured by collateral, though the announcement didn't specify this. But we see this in many sectors. For example, during the last financial crisis, lots of commercial real estate loans ended up secured by property, which helped banks recover more value if defaults happened. We should also mention loan covenants. A covenant is a condition in the loan agreement. Like the borrower must keep its debt to EBITDA ratio below X, or must maintain a certain cash balance. Covenants protect the lender by ensuring the company remains financially healthy. Violating or breaching the covenant can trigger penalties or forced repayment. In fact, the news often quotes companies struggling to meet covenants. One Reuters piece explained that some firms even moved from loans to bonds to escape punitive financial covenants. Bonds typically have no covenants, which is why, as one banker said, firms sometimes pay off loans by issuing bonds, even at higher interest, just to avoid strict covenants. Here, pay off is another phrasal verb meaning to completely repay debt. So keep covenants in mind. They're like warning signs on a loan. Now let's talk about liquidity and related risk. Liquidity basically means having enough cash or liquid assets to pay expenses or debts when they come due. For banks and businesses, liquidity risk is the danger of running out of cash. Companies maintain liquidity reserves. These are cash or unused lines of credit to handle surprises. For our example, Lenzing's CFO said the new loan strengthens our liquidity reserves, meaning the company has more cash or credit on hand now. Banks themselves worry about liquidity. A recent Reuters article reported that the European Central Bank, or ECB, asked banks to check their balance sheets for any funding gaps. In plain language, they told banks, look, if you've lent out money in dollars but you don't have enough dollar funding, that's a hole. You need to shore up or fix that gap. The article said banks had lent out dollars to clients but don't have sufficient or reliable funding in that currency to meet liabilities. In other words, banks must avoid situations where they can draw down their dollar reserves too much. Draw down is a phrasal verb meaning to use or withdraw a portion of a credit line or reserve. If something goes wrong, they need to have enough to cover their own obligations. Another key term is liquidity coverage ratio. Regulators often require banks to have high quality liquid assets to cover short-term outflows. That's a detail of Basel rules, which we'll touch on soon. But on a company level, think of liquidity similarly. Do they have enough cash to pay suppliers and employees this month? If not, you may need to draw down on a credit line or request an overdraft from your bank. Banks also practice risk management by hedging exposures. For example, imagine your company earns monies in euros but has loans in US dollars. A rising dollar would increase your debt cost. To guard against that, a treasurer may hedge currency risk using derivatives. In fact, Reuters recently reported that many corporate treasurers are increasing FX hedging due to a surging dollar. They use forward contracts, options, or currency swaps to lock in exchange rates. A swap is a derivative where two parties exchange cash flows. An example would be one pays fixed interest, the other variable. In a similar way, companies might hedge interest rate risk by using an interest rate swap if rates go up. The general term derivatives covers forwards, futures, options, and swaps. These tools help firms reduce their risk. If you hear a banker say, "We hedged our exposure," it means they used one of these instruments to protect against adverse price movements. If liquidity dries up, a company can face an enforcement or even default on a loan. A default means missing a payment or breaching a covenant. In extreme cases, businesses restructure or banks may write off bad debt. Write off is another phrasal verb. It means the bank decides a loan won't be repaid and removes it from their books as an asset. This happened a lot after the 2008 crisis, and some banks still write off loans when companies go bankrupt. A Breaking Views analysis noted that US banks have reserved about $2.08 for every $1 of past loans. This is down from $2.78. This coverage ratio shows how much money banks set aside to cover defaults. Lower ratios mean they might have to write off more if loans go bad. Another interesting term is a non-performing loan, or an NPL. This is a loan that's in default or close to it, usually 90 plus days past its due. When loans turn non-performing, banks increase provisions or reserves and may ultimately write them off. A recent Reuters piece noted that loans 90 days or more past due rose by 10 billion, and all of that improvement in delinquency appears to be covered by modifications. Notice how banks modify loans. They extend terms or reduce payments to help borrowers avoid defaults. This is another strategy to manage risk. But if the borrower truly can't pay, the loan becomes non-performing. Let's move on to talk about capital buffers and what happens when things go really wrong, a bailout. After the 2008 crisis, regulators worldwide reinforced bank capital requirements. Basel III rules require banks to hold high-quality capital, like Tier 1 capital, to absorb losses. In fact, the EU recently rolled out the final batch of these rules. A Reuters report noted the EU approved the remaining Basel III rules, building on safeguards introduced after taxpayers had to bail out lenders in the global financial crisis. In other words, after the crash, governments had to bail out banks, give them public funds, so now banks must be safer on their own. A capital buffer or capital requirement is the extra capital above the minimum Tier 1 ratio that banks must hold. Think of it as a cushion. If the bank suffers a loss, it eats into the buffer before hitting depositors' money. The Basel output floor, a new rule, prevents banks from underestimating risks by using fancy models. These buffers are like the loan confidence for banks, rules they must follow or face consequences. If a bank's capital falls below requirements, regulators may force it to raise capital or even stop lending. On the flip side of capital, we have the concept of bail-in and bail-out. Bailout is when an outside party, often a government, lends or gives money to a failing bank or company to keep it solvent. Bail-in is when the bank's own creditors, shareholders or bondholders take losses to recapitalize it. We heard a lot about bailouts in 2008. Now regulators prefer bail-ins when possible. For example, when banks went bust, shareholders were wiped out and uninsured bondholders absorbed losses. That's a bail-in. But in extreme cases, governments stepped in to prevent systemic collapse. Let's turn the tables though. Suppose your company is about to fail. A friendly merger or acquisition by another firm could be like a bailout. In corporate terms, to bail out means saving a failing company with cash or a buyout. Conversely, to bail in could mean creditors agree to accept less money so the company survives. These are advanced terms, but you might hear them in high-stakes finance discussions. Let's circle back to some terms around credit quality. We already mentioned collateral. These are assets securing a loan. When things go bad, secured loans have a better outcome because the bank can seize the collateral. For example, the Breaking Views article pointed out that when commercial real estate loans default, banks often recover more because debt is secured by property, leaving something of value to seize. In contrast, unsecured loans, like a credit card, have no collateral and higher losses. If a loan goes bad, banks increase reserves. We saw that big US banks now have $2.08 in reserves per every $1 of troubled debt. That's known as the coverage ratio. Some banks have less than $1 of reserves for every $1 of debt past due, which is very risky. When reserves aren't enough and losses mount, banks must write off those loans. Writing off a loan means the bank acknowledges the debt likely won't be repaid, so it removes it from assets and charges it to earnings. It's a last resort, but it happens. Another point, if your company is over-leveraged, you may need debt restructuring. This can involve rolling over debt, extending maturities, or converting debt to equity. Rollover is a useful phrasal verb. It means to renew or extend a loan or debt that's due. For example, if your 3-year loan matures but you don't have cash to repay, you might negotiate to roll it over for another year. While it can give breathing room, it also adds more interest expense. Rolling over without improving fundamentals only kicks the can down the road. Likewise, if your company is struggling, lenders might impose tougher covenants or higher interest. If you can't negotiate better terms, sometimes banks will write down a loan. That's related to write off or even walk away, another term for to exit a deal. These are all things every finance professional discusses behind closed doors. One term we haven't covered yet is underwrite. In banking, to underwrite means to guarantee or take on financial risk, often by issuing securities or loans. For example, when a company issues bonds or stocks, an investment bank may underwrite the offering, meaning the bank guarantees it will sell all the securities, or buying any unsold portion itself. Underwriting is also used for loans and insurance. A recent example in the market was collateralized loan obligations, or CLOs, which are pools of leveraged loans sliced into tranches. Reuters noted that investment banks underwrite CLO securities and sell them to investors. In other words, the banks vouch for the loan-backed bonds and handle their distribution. If you're in corporate banking, you might work with teams that underwrite huge deals. So when someone says, "We underwrote the new debt issuance," it means the bank guaranteed its sale. Alongside underwriting, banks use many financial instruments to manage funds. We already mentioned derivatives, swaps or forwards. Another buzzword is capital markets, selling stocks or bonds on public or private markets. A bank's corporate clients might tap capital markets when they need to raise cash beyond bank loans. And banks facilitate that by underwriting or advising on bank issues, IPOs, and things like that. So let's wrap up by hearing how these terms come together in real life. Picture a tech startup that needs 50 million to expand. The chief financial officer approaches the corporate banking team. They say, "We can arrange a syndicated loan for you, with a revolving credit line of 20 million and a term loan of 30 million. You'll need to agree to covenants on your cash burn rate, and we'll hold a lien on your servers as collateral. Once approved, you can draw down funds as needed." So after a year, if the company isn't generating enough revenue, the banks may renegotiate terms or even write off part of the deal if the startup goes under. Meanwhile, the startup's treasurer could use swaps to hedge any euro-dollar currency exposure and closely monitor the liquidity runaway. Another story that brings these terms together is, during the pandemic, many governments bailed out airlines and banks. In those rescue deals, governments often took equity stakes, a kind of bail-in of shareholders, or guaranteed bonds, another capital buffer. Those companies came back stronger later, showing why capital buffers and good risk management are vital. So today's key takeaway: these banking terms show up in the news and boardrooms all the time. When you hear about a company rolling over a loan, bailouts, or capital buffers, you'll now understand what's happening. Also, if a CEO mentions liquidity, you know to ask whether that means cash on hand or credit facility. And when a banker talks about writing off debt or hedging risk, you'll know the implications for financial health. Remember to practice these terms. You should check out episodes 6, 7, and 8 of the podcast. They all cover finance and money in business, and they tie in very nicely. Of course, comment below with your questions and subscribe for next week's episode. join my Business English playlist for more episodes on vocabulary and skills. Everything is linked in the video description. If you've enjoyed this deep dive, don't forget to like and share it with your colleagues. Have a chat about it. It's a great way to buffer up your skills when it comes to these terms. Subscribe to Learning English Pro and click the bell for notifications. And remember, for just $4.99 a month, you can become a student member. Get PDF guides for each new lesson, along with instant access to my PDF guide directory and video archive. Have a request for a video lesson? Your request gets priority with student membership. Click the link in the video description or the button just below this video to join. Next week's episode is episode 10, the finale of season 1 of the Business English podcast. So make sure to leave a comment with your question relating to professional business English, money, and really anything else that you wanted to know. This has been the Business English podcast from Learning English Pro. I'm Jer. Thanks so much for joining me today, and I'll see you in the next episode next Monday.